Imagine you found a magic lamp and you're granted 3 wishes. Surprisingly, you don't wish for eternal wealth, but for the wisdom to grow your treasure. Smart. But here's what even the genie won't tell you about investing. Seriously, folks, we're about to dive into something that could change the way you see your dollars and cents. Because, let's face it, money doesn't grow on trees. But what if, just what if, with the right know-how, your bank account could start sprouting some serious grain? Investing isn't just about throwing your money into the stock market and crossing your fingers. It's a game of strategy, calculated risks, and sometimes patience that would put a glacier to shame. Today, drawing inspiration from the one and only Dave Ramsey, we're going to steer you clear of the treacherous cliffs of poor investment choices. Entrepreneurs, hard workers, dreamers, I'm talking to you. Whether you're saving for retirement, a home, or just looking to grow what you've got, this is your gold nugget of wisdom. So perk up those ears and grab a notepad. Things are about to get interesting. Now moving on to the first headline. Headline 1. Understanding the basics of investing. So what is investing? Investing is kind of like planting a seed in your backyard. You water it, make sure it gets sunlight, but instead of growing into a lovely tomato plant, you're hoping it'll grow into a money tree. Okay, scratch that. Money trees don't exist, but your investment growing, that's very real. It's about putting your hard-earned cash into something today, whether it's stocks, bonds, or real estate, and having more money tomorrow. Good versus bad investment. Let's talk about Jack and Jill. They both decide to invest $1,000. Jack, he's a bit of a go-getter, does his homework, and puts his money into a well-researched, diversified index fund. Over time, his investment grows steadily. Jill, on the other hand, overhears a tip about a hot new cryptocurrency. Without doing her due diligence, she throws her grand into this next big thing. And then, well, the crypto market does its roller coaster thing. And that investment ends up as nothing more than digital dust. Jack's patient, informed approach compared to Jill's impulsive, hearsay-driven gamble shows us a stark contrast between a good and a bad investment. Jack's money hasn't just grown, it's flourished like a well-tended garden. Jill's cash, it's like the seeds were scattered in a desert. No growth, just gone with the wind. See, good investment isn't just luck. It's a blend of vigilance, foresight, and sometimes knowing when to hold them and when to fold them. Understanding the basics sets the stage for smarter decisions down the line. So let's move on to the common traps you'll want to sidestep. Headline 2. The common traps of investing. Emotional investing. Let's face it, we're emotional creatures. We love, we hate, we get excited, and yes, we even get a bit greedy sometimes. That gut feeling, it shouldn't be the captain of your investment ship. Emotional investing is like trying to drive while blindfolded. You're gonna hit something, and it ain't gonna be pretty. When emotions lead astray. Picture this, Felicia's all about that savvy financial life. She's got a little portfolio she's quite proud of. One day, she catches wind of a hot stock tip from a friend who just has a feeling it'll soar. So Felicia, caught up in the moment, goes all in, and you guessed it, that stock ended up sinking faster than a sumo wrestler in a kiddie pool. What Felicia didn't know was research the company or consider the timing. No, she let excitement hijack her common sense, and her investment went belly up. This is a classic scenario where emotions, like excitement or fear of missing out, can cloud judgment and lead to choices that are, well, let's just call them suboptimal. Remember, the stock market doesn't care about feelings. It's about facts, trends, and cold, hard data. So now that we know emotions are bad co-pilots on the investment journey, let's talk about the single greatest mistake that can throw a wrench in your financial engine. Headline 3. The single greatest investing mistake. Where's the plan? Drumroll please. The biggest blunder, the colossal error, the grand faux pas of investing? It's not having a clear plan or understanding of your investment. That's right, flying blind, no map, no compass. Dave Ramsey's way out. Dave Ramsey, he's like the Gandalf of personal finance, says that baby steps are the way to go. He advises us to first get a grip on debt, build an emergency fund, and then start investing 15% of our household income into retirement accounts. It's about systematic progress, not random guesses. Without a clear plan, you might as well be throwing darts at a stock list while blindfolded, and the results would be just as random. A plan acts like a blueprint for building the financial future you want. It means setting goals, understanding your risk tolerance, and knowing what you're putting your money into and why. It might not be as sexy as doubling your money overnight, but it's a heck of a lot more reliable. So, what's the answer? Education, a solid game plan, and the discipline to stick to it. It's about building wealth responsibly and sustainably. Think tortoise, not hare. Now, let's look at why armoring yourself with knowledge and patience is as crucial as having a plan. Headline 4. The power of knowledge and patience in investing. Research pays dividends. Knowledge. It's your best ally in the investing world. We're talking about understanding what makes a good business tick, what affects market trends, and which investment strategies align with your goals. It's grabbing the financial bull by the horns and flipping through earnings reports rather than relying on gut feelings or rumors. You wouldn't buy a car just because it's red and shiny, right? So don't invest in something just because it's making headlines. Patience, the investor's virtue. Ever heard of compound interest? It's like a snowball rolling down a hill. It starts small, but given enough time, that thing can become an avalanche. Let's say Barbara starts investing $200 a month from age 25 to 65 in a retirement fund with an average growth of 8%. By retirement, she sits on a nest egg of over $1 million. Had she waited until 35 to start, she'd have less than half of that. It's a long game, friends. A watched pot never boils, and a constantly tinkered portfolio never flourishes. Be like Barbara. Plant those seeds, then give them time to grow. Next up, we're going to break down some golden rules of investing, straight from the financial whiz Dave Ramsey himself. Headline 5. Dave Ramsey's Golden Rule of Investing. Ramsey's Philosophy. Dave Ramsey's approach to investing isn't some sort of cryptic sorcery. It's good old-fashioned common sense wrapped up in discipline. He emphasizes mutual funds, especially ones with a long history of strong returns. Diversification is a key theme. It's the financial equivalent of not putting all your eggs in one basket. Practical investment steps. Let's distill some of Ramsey's golden rules. Invest in what you understand. If it's too complex, you're setting yourself up for a nasty surprise. Keep it consistent. Regular, disciplined contributions trump erratic, large-sum investments. Steer clear of debt. Using borrowed money to invest is playing with fire. Instead, focus on investments you can fund with available money. By adhering to these principles, you're not just avoiding common pitfalls, you're paving a road towards a stable and potentially prosperous financial future. Alright, let's talk about what you can do starting today to steer clear of the big investing no-no we discussed. Headline number 6. Actionable steps to avert the biggest mistake. Action plan. You want to avoid the biggest investing mistake? Get proactive. Here's a step-by-step guide. Define your investment goals. Are you saving for a house, retirement, college? Pin it down. Assess your risk tolerance. Can you stomach the ups and downs of the stock market, or do you prefer more stable investments? Educate yourself. Take the time to learn about different types of investments and how they work. Start small and scale up. You don't have to go all in day one. Invest steadily and increase your contributions as you become more comfortable. And remember, this aligns with Dave Ramsey's advice too. Knowledge, patience, and a solid game plan are your best friends in the realm of investments. We're wrapping up, but not before we take a moment to look back on the nuggets of wisdom we've uncovered today. Conclusion. We've explored the investing landscape, understanding the basics, avoiding emotional decisions, crafting a clear plan, and embracing the virtues of knowledge and patience. And let's not forget about Dave Ramsey's golden investment pearls. These are more than just tips. They're the cornerstone of a stable, prosperous financial future. Smart investing isn't a sprint. It's a marathon that requires endurance and a steady pace. Remember to engage with the content. Subscribe, like, share, and comment with your own investing experiences. Every interaction is a step towards building a community that thrives on shared wisdom and support. And hey, keep your eyes peeled for our next video. We'll be diving even deeper into the waters of wise financial decisions. Until then, keep those investments growing and those plans bulletproof. Happy investing!